Most advice that you'll hear around taking on debt is to avoid it at all costs and to pay it off as fast as you can. But the financial environment that advice was built for doesn't exist anymore, and Bitcoin changes the math on how you should be thinking about debt. So in today's video, I'm going to show you what traditional advice says about debt, why it made sense in the past, and how Bitcoin changes how I think about debt in today's world. So let me start with why the advice made sense in the first place. To understand debt, we first need to talk about interest rates. They're how debt is priced all over the world, and they're critical to understand when you're making financial decisions. Interest rates are the price that you pay to borrow money. This price is set by the Federal Reserve, and it moves based off of several different factors like how likely you are to pay off the loan. This is measured by your credit score, how long you need the money for the term of the loan, and the state of the economy. Interest rates are a tool used by the Federal Reserve to either stimulate or slow down the economy. And rates have changed drastically over the past 50 years, and this has a huge impact on how most people today think about debt. We've seen financial educators like Dave Ramsey build an entire career around teaching people that avoiding debt and paying it all off was the safest and smartest move that you could make. Back in the 1980s, mortgage rates peaked at 18.45%, and they were the highest ever recorded. So paying off a mortgage was like getting guaranteed returns that were better than what you would get in the stock market without taking any risk. During the same time period, wages actually rose with the cost of living. So from 1980 to 1990, the median household income grew at 29%, while inflation was 26%. The median home price was $47,200, while the median income was $21,000. But today, the median home is $417,000, while the median income is $80,600. So now it's 2.5 times harder today than it was in the 1980s and 90s to afford a home. Debt was unnecessary because the cost of things that you need, like food, groceries, college tuition, and healthcare, could all be paid for with savings and wage increases. So the incentives were actually to avoid debt and to pay it off as fast as you could. High interest rates would burden you with even more stress, and loans were actually working against you. And this advice worked for that time period, but there's 3 major things that have changed today that challenge how debt should be utilized. The first shift is that interest rates have been falling since the 1980s from double digits, like we talked about at 18%, down to almost zero. So the guaranteed returns that you get by paying off debt in the 1980s no longer exist. Right now, 62% of US homeowners have mortgages that are below 4%. So the return that you get from paying off a 30-year mortgage early has gone from 18% down to 4%. The second major shift is that inflation is higher and more persistent than it's been in the past. You might think that household debt growth is fueled by bad spending habits. We've seen the rise of instant gratification, social media, cell phones, and packages that we get from Amazon with the click of a button. But debt isn't only just about bad behavior. 78% of Americans live paycheck to paycheck. People aren't just taking on debt because they're irresponsible. They're being forced into it just to keep up with the cost of living. So inflation has gone from 2 to 3% to over 6% in the past few years. And inflation is structural now, and it's not going away because the system needs more and more debt to survive. And as the debt continues to grow, so does demand for desirable goods and services that you want. And this pushes the prices of everything up that everyone needs to live. Debt levels are rising because wages haven't kept up with the cost of living. Housing, healthcare, and college tuition are all up triple digits, while real wages have struggled to keep pace since 2000. The third major shift is that Bitcoin exists now, and since 2009, Bitcoin's averaged over 100% annual returns. So going forward, even conservative projections estimate Bitcoin's returns around 20 to 30% as adoption continues to grow. If you compare that to your 2.5 or 4% mortgage, the opportunity cost of paying off cheap debt instead of buying Bitcoin is massive. So for anyone with low interest debt, it makes a lot more sense to invest the extra cash into assets that return higher than what you're paying on the interest rate. But before you go out and take on debt to buy Bitcoin or other assets, you need to understand why this strategy works for some people and it fails for others. Debt multiplies whatever position you're in. So if you're fragile, it can ruin you, and if you're strong, it can multiply returns and increase your wealth. Most people living paycheck to paycheck today with a mortgage, student loans, and credit card balances are using debt because they can't afford things like food and living expenses. And this fragile financial position prevents most people from being able to own assets that you need to own to outpace inflation. At the same time, someone who's in a strong financial position with excess income every month can invest in assets. As the value of their assets rise with inflation, their financial position gets even stronger. So they get access to better loans with lower rates and longer terms than someone just trying to pay bills because the bank sees them as less risky. They can then use cheap debt to buy more assets and amplify their returns even more. For them, debt becomes a tool to build wealth and not a burden like it is for most people. The person that's struggling to get by doesn't have the same option, and any short-term investment loss can completely wipe them out. So in a high inflation system, long-term fixed rate debt from a position of strength can work for you. While on the flip side, short-term high interest debt and a low level of assets can destroy you. Most people get this wrong because they assume that debt and leverage is a tool to help you amplify and increase your wealth even faster. But if you do this from a fragile financial position, it's more likely to leave you with nothing. So before you start thinking about using debt to acquire assets, you need to think carefully and consider which person that you are here. Focus on increasing your income and reducing your expenses so that you can start to build an asset base first. And if you want help building your Bitcoin-focused financial plan, I write emails showing you exactly how to do it. I'm also working on building an all-in-one financial planning tool that's a software to help Bitcoin holders organize their finances and things like tax strategy and retirement planning long-term, as well as debt management, and a lot of other features. So if you're interested in that, I'll be releasing it to the email list first. And if you're in a position of financial strength or building towards that, Bitcoin is the best asset to use to solidify that position because it's designed to be the complete opposite of the debt-based system that we live in today. To understand why Bitcoin changes everything, you need to understand the two monetary systems that we're living in between. Today, money is created through debt, and when banks issue new loans, new dollars enter the system. The money supply has grown from $1.6 trillion in 1980 to $22 trillion today. From 2020 to 2022, the Fed printed $4.8 trillion, which is 26% of all dollars ever created. And this keeps most people that don't have access to a money printer like the government struggling to get by as everything gets more and more expensive. And as spending increases and total debt levels rise, this problem only gets worse because more new debt is needed to pay off the old debt. And instead of defaulting on the debt, they'll continue to issue more and more debt, knowing that they'll be bailed out with printed currency. In this system, borrowers are rewarded because inflation erodes debt while assets appreciate. You borrow today and pay back with cheaper dollars later. Bitcoin is not just a new asset class or an investment. It's a monetary system based on equity and a fixed supply of 21 million coins. This is the complete opposite of the financial system that we live in today. Now, in this system, productive people are rewarded instead of people who borrow money. Right now, we're living through a unique transition period where both systems exist alongside each other. What this does is this gives you the ability to hold debt in the system designed to expand forever and use it as a tool to accumulate Bitcoin in a system that's designed to hold value forever. Let's say you have $100K left on your mortgage at 2.5% fixed for 20 years left on the loan. If you decide to pay off the full amount today with $100K in cash, you'd save $27,000 in interest over the life of the loan. But if you put that $100,000 into Bitcoin instead and just paid minimum payments over the next 20 years, you'd pay $27K in interest and have around $18.9 million in Bitcoin at 30% returns per year. But not all debt is created equal, so let's break down types of debt from the worst to best. And now it's critical that you have a good understanding of these types of debt because of how volatile Bitcoin can be. In general, the higher the rate and the shorter the time frame, the more risk that you're taking on and the more likely you are to lose from a vulnerable position. The worst kind of debt you can hold is a short-term debt with high variable interest rates, and these are things like credit cards, buy now, pay later plans, and payday loans. They're typically going to have double-digit interest rates that can change depending on how rates are moving in the economy and the financial position of the bank. At 20% or more interest, you're paying almost as much as Bitcoin's projected returns going forward. And right now, the average credit card APR is 21.39% in 2025, and Americans paid $250 billion in credit card interest in 2024. And you don't want to be one of these people, so this is the kind of debt that you want to avoid and prioritize paying down or refinancing with better terms. The next type of debt is neutral debt with moderate interest rates and terms. So rates are going to be 5 to 10%, and terms are going to be anywhere from 3 to 15 years. These loans are going to be for vehicles that you need, student loans, some mortgages, and personal loans. At 5 to 10%, the gap between debt costs and the returns that you get on Bitcoin are more significant. So holding this debt while buying Bitcoin could start to make sense. The third type of debt is more strategic. This is debt with long terms and low interest rates that are going to be significantly below the return that you'll get just by holding Bitcoin. Typically, these are going to be 20 to 30-year mortgages with rates anywhere from 2.5% to 6%. Now, I encourage you to really evaluate the opportunity cost of investing in Bitcoin instead before paying off these types of loans. Because with high inflation and low rates, these loans become a tool to help you grow your wealth. This last type of loan has significant risks, and I would actually caution against using these to either buy Bitcoin or finance your life. These are Bitcoin-backed loans, and they work by pledging part of your Bitcoin to a lender in exchange for dollars. Rates here are anywhere from 10 to 13%, and they can be used as an option for someone that holds Bitcoin and might have a hard time getting a loan from a bank without an income. But there's two major risks that you really need to consider here. If Bitcoin's price drops quickly and you don't add to the collateral, you can lose the entire balance. The second is that you need to trust that the lender that you're using is solvent and won't go bankrupt and lose your Bitcoin. So first, I would look carefully at how much Bitcoin you have relative to the loan. You'll want to make sure that you can endure price drops in Bitcoin anywhere from 70 to 80% in a short time frame like we've seen in the past. All of these types of debt that I just talked about carry some form of risk, so let's talk about what they are. Before we get into debt strategy, we need to cover the biggest risk most people underestimate, which is their own psychology and risk tolerance. Money can already be really stressful, and then you add debt and combine that with Bitcoin's volatility, and it becomes very difficult to handle for most people. 73% of Americans rank finances as their number one source of stress. People with high debt are 3 to 4 times more likely to suffer from depression and anxiety. So taking on debt brings a significant mental load, especially if it's bad debt or if it's structured in the wrong way. This can then cause you to make even worse financial decisions under stress and end up with less Bitcoin. Bitcoin is extremely volatile and it can drop 70 to 80% like I just talked about, and this can squeeze you financially if you're over leveraged and you're not prepared for it. Another major risk that you need to consider is job loss or income variability. Payments on your debt don't stop when your income does, and you can mitigate some of this by establishing an emergency fund and setting cash aside to make sure that you can cover your debt payments. One of Bitcoin's biggest benefits is removing counterparty risk. But if you borrow against your Bitcoin and give it to a lender, you're reintroducing that risk. And you can mitigate this by holding coins in self-custody and prioritizing unsecured debt first. I personally believe that Bitcoin is the best investment you can make over the long term, and anyone choosing to invest needs to first fully understand what Bitcoin is and the problem that it solves before you think about taking on debt to buy it. Before you make any decisions, let me break down some steps for how I think about debt in my own financial plan. Step 1 is to eliminate high interest variable debt. This is getting rid of debt that has rates close to what Bitcoin's long-term projected returns are. And what this will do is this will decrease risk and free up cash flow for yourself, and it will strengthen your financial position. Next, you'll want to build an emergency fund to protect your downside and make sure that you can pay bills if you were to lose your job. Step 3 is to sit down and get really clear on what your income and your expenses are. You'll want to reduce your variable expenses as much as you can so you can start using additional cash flow to buy assets. Step 4 is to evaluate the remaining debt that you have on your balance sheet right now. So for each debt that you have, you'll want to ask yourself these questions. What is the rate? Is it fixed or variable debt? How long is the term, and can I easily afford the payments? You'll want to then compare that to what you think Bitcoin's projected returns are over the next 20 to 30 years. Step 5, if you're comfortable holding the debt that you have after asking these questions, then start investing in Bitcoin instead of paying these loans off early. Next, your primary focus is building your asset base to a point where your assets are higher than any debt that you have. A debt to assets ratio measures the level of debt that you're holding to the amount of assets that you can sell to pay off the debt. For most people, a debt to assets ratio around 30% is considered pretty good, but the higher that this number goes, the more vulnerable you are. Step 7 is to only consider taking a Bitcoin-backed loan or additional debt if you can survive an 80% drawdown on the asset and your debt to assets ratio is strong. You'll want to start with a plan for how you pay back the debt before you take it out. You'll want to understand the risks that you're taking by moving Bitcoin to a lender. My personal rule of thumb with this is that you shouldn't use more than 10% of your Bitcoin holdings, but again, this is a personal decision, so you'll want to think through it carefully before doing anything. My thought process on this is with 10% of your stack used as collateral, you'll be able to add to it if Bitcoin were to draw down 80% with a low risk of losing the Bitcoin. Now, I do think holding your mortgage and buying Bitcoin will outperform paying it off early, but I totally understand if you'd sleep better at night being debt-free. Because if you're not comfortable holding debt and you can't sleep at night, I don't think there's any amount of money in the world that's worth sacrificing your health. The key takeaways here are that understanding and conviction in Bitcoin is a prerequisite to buying it, and you should probably start there. You should only use debt as a tool from a strong financial position and build your asset base first. I don't think using debt is necessarily good or bad, it's just a tool that you can use strategically if that choice is right for you. These ideas and frameworks can help you capture additional opportunities and add to your Bitcoin position over time. And you can benefit from the high inflation environment that we're in today while Bitcoin's still adopted by the world. Because we live in a unique point in history where you can acquire weaker money to buy stronger money. And this time won't last forever, so take advantage of it while you still can. My name is Austin. Thank you so much for watching, and I'll see you in the next video.